Now, I always joke that there's two things that I'll never sell clients: drugs and annuities. Now, I always just say that I don't sell anything. I'm a fee-only firm. But what I'm getting at is I think that annuities are products that are sold and they're not bought. And judged by how big the annuity industry is, it's obviously that somebody is selling these. Last year alone, annuities had over $200 billion in sales. So these are very, very prevalent products. In fact, I never get a new client who doesn't have an annuity stuffed somewhere in their portfolio. And as we go through this video, you'll see exactly why they're so prevalent in people's portfolios.
The first reason to avoid variable annuities is the cost. They are egregious. Typically, there's 3 charges with every variable annuity. The first charge is for the underlying investment, which is usually a mutual fund, and those run typically about 1.25% per year. Then there's a mortality and expense charge. That typically runs about 1.25% as well. And what that essentially does is it buys insurance that if you were to die, your heirs would get back at least as much as you put into the annuity. So if you put $100,000 into an annuity and you died and it was only worth $80,000, your heirs would still get $100,000. Now, the third fee isn't really that much. It's just an administration fee, which is typically about $30 or maybe 0.15% per year. But when you add all this up, you're looking at 2.5% or greater just to have the variable annuity. Now, I want to spend just a few seconds isolating the mortality and expense charge and show you why it's really egregious. Let's say you buy an annuity and you put $100,000 into it. Now, the first year, your mortality and expense fees, if it's at 1.25%, is going to be $1,250. Now, let's say at the end of the next year, your annuity had dropped to $80,000 in value. And let's also say that you had the unfortunate accident and died. Well, that $1,250 that you spent on the mortality and expense fee basically is going to ensure that your heirs receive $100,000 rather than just the $80,000 that the annuity is worth. So it seems like a great deal. That $1,250 basically bought you $20,000 in insurance. But the problem is you pay this M&E fee every year, even as the account gets bigger and bigger. So let's say the account starts to grow from $80,000 and you don't have that unfortunate accident and die. Well, a few years later, that $80,000, the annuity has grown to $300,000. Well, you still have that 1.25% mortality and expense fee. So now you're paying $3,750 per year in case the annuity happens to be worth less than $100,000 when you die. Now, the probability it's going to drop from $300,000 below $100,000 is really small. So you're essentially paying for insurance that is worthless. Now, the insurance company knows this. They make a handsome profit every year on all the mortality and expense fees that they charge their clients. It's just a useless expense after you get past the initial $100,000 investment. In fact, when you add it up over time, you end up spending thousands upon thousands for insurance that you would never, ever even use. One of the benefits that annuity salesmen always talk about when they're selling annuities is its tax advantages. But I'm going to show you that's actually not an advantage at all. Now, it is true that the gains that you have within a variable annuity are not taxed until you pull the money out. But the problem is when you do pull these gains out of the annuity, they're taxed as ordinary income. Whereas if you put the money into a regular taxable account and then you sold the investment and had a gain, you'd only be taxed at the capital gain rate on that gain, which is currently 15% if you hold it for more than a year. But many people are in a tax bracket that's substantially higher than 15%. So you could end up paying even higher taxes on the gains within the annuity. The other thing that they talk about when they're selling annuities is how a portion of the distribution that you receive comes back to you tax-free. Well, that's kind of misleading. It's true that if you pull out, let's say, $10,000, maybe $5,000 of it's taxable and $5,000 isn't. But that portion that isn't taxable is just strictly a return of your initial contribution. So if you put $100,000 in initially and you pull out $10,000, and only $5,000 taxable, what that's saying is it's giving you $5,000 of your initial $100,000 back. So why would you pay tax on money that you put in there? It doesn't make sense. But it certainly makes for a nice sales pitch when they're trying to sell the annuity. Another disadvantage of a variable annuity is you don't get a step up at death. What that means is if you owned an asset outright, let's say you put $100,000 into it, and when you died it was worth $150,000. Well, for tax purposes, your heirs would inherit that asset at $150,000. They'd only pay tax as if the value went up above $150,000. Now with the variable annuity, if you put $100,000 in and at your death it was worth $50,000, your heirs are still going to pay tax on that $50,000 gain. So you can see that it actually creates a tax disincentive if you're going to be leaving this money to your kids or your wife or anybody else, because they don't evade those taxes.